Welcome to the VSA Tech and Transitional Energy podcast on Thursday, the 12th of May. This is David Scriven and Phil Smith. Phil, how are you?
I'm very well, thank you very much, David. Great to talk to you.
It's a pleasure, sir. To start, we'll focus on the news and then have a discussion at the end on the tricky environment we're currently in. So if you could kindly lead us off with renewables, that'd be great.
Yeah, we'll do, David. I mean, I don't know if you saw this week, but apparently this was an article that was in Recharge that I picked up on, is that BP is going to take a major stake in the Asia Renewable Energy Hub. And it's a huge project. It's in Australia. And this is to produce green hydrogen from wind and solar. And it says that BP are taking a 30% stake in that. And the project is poised to tap something like 16 gigawatts of onshore wind. And we're seeing an increasing amount of news flow, obviously, from the oil majors on renewables. And this has been followed by Shell, another UK stock, and it's Shell today announcing that it's promising to install 50,000 EV charge points across the UK by 2030. Well, that's only in 8 years' time. But the UK is just to put that into scale. The UK currently has around 30,000 charging points. So that's going to be very, very welcome news for a lot of EV owners, I am sure, because charging capacity has been one of the big bugbears. So that's two of our big oil majors getting, with news on renewables. Also of note, I think this week was from the International Energy Agency, the IEA, who track global data on renewables, and they said that renewable power capacity hit a record of just under 300 gigawatts in 2021, and this year that's expected to rise to with 320 gigawatts installed of solar, mainly solar and PV, and of course, when we've talked about it a lot on the podcast, the solar in particular needs battery storage to go with that. So, renewable capacity set to increase there. But they also cautioned on 2023 renewables, saying that they needed to see more, announcements from governments of initiatives on this. And they saw, installations plateauing. And then just quickly on that, and on government initiatives of renewables, and this will affect transitional energy companies without doubt, is that the EU's already said it wants to speed up the bloc's green transition. Obviously, part of that's due to geopolitical issues and dependency on gas. So that is, could be positive for the sector. And we've already seen Germany, David, have said that they're earmarking additional $200 billion to fund, industrial transformation between now and 2026. Again, only 4 years ago, and that includes climate protection and hydrogen. So that's, just looking at the sector on transitional energy, those sorts of announcements are actually all very positive news. And that kind of leads us in to some of our company comments. And on the subject of battery and battery storage technology, David, I think you would like to talk about Ilika, who had an update this week.
Yeah, indeed I will. And just before I launch into Ilika, I was just say on your observations, as you say, the trends are very favourable. But by the same token, we do need, as fast as we possibly can, speed up the process or encourage the process to gain even stronger momentum. But hopefully that will be the case. Anyways, in terms of Ilika, we had a trading update and notice of results, trading in line at 500k and EBITDA loss of 7 million. But I just backspace a little bit here, because following a capital markets day, which was basically the end of last year, and 50 million worth of investment to advance Sterex manufacturing, this is, of course, the micro solid state batteries, to process and production qualification, the eye catcher was the comments on Sterex manufacturing. To quote, "It's taking longer than anticipated to ensure that product batches reproducibly meet specification. Demand now weighted to miniature medical device applications, Now, these applications have a longer regulatory cycle compared to what I thought to be one of the key focus being industrial and the Internet of Things. The shift in this weighting to customer demand towards medical device applications, combined with the expectation of optimization cycles continuing into H2 23, means the company now expects commercial sales to commence at the end of that period, so later than originally expected. So the shares are under quite some pressure here, having halved since February and actually down 70% since that capital markets day. However, I do note that the company does have 23 million of cash as at the 30th of April, as at least a kind of a balance sheet backstop here. So, Phil, if I could hand on to you for your thoughts on Ideagen.
Yeah, well, this is just moving on to from sort of transitional energy onto tech. Ideagen, the ticker is IDEA, and the market cap now is £1 billion. It has been bid for. And this is a software company that sells into the regulatory and the compliance markets. 5,000 clients, and this is across accounting, defense, aerospace, pharmaceuticals, a great spread of end customers for the business, and it sells into blue chip brands. Here's a classic on sort of valuation. Bear in mind this has had a bid, right? The shares today are 350p around the bid price, but they'd fallen from 320p in September to 196p in March 2022, and they raised 100 million at 270p only in December. So, clearly external parties have been watching Ideagen, which is a high quality business, and watching its valuation, and it's had a bid from HG, who are a very well-known software services investor, and it's for the entire issue. So this is a complete bid. And what they've said is Ideagen, that the directors intend to recommend unanimously that shareholders vote in favour of that acquisition from HG, and I think it's at 350p. I'm sure someone will correct me if I am wrong. It's also said that it's still in discussions with French PE firm Astorg, who've been granted access for due diligence, but in classic they've said there's no certainty if an offer will be made, etc., etc. So the 350p and the valuation. So it's £1 billion, values the company at £1 billion. And the company today's issued a trading update, and it says its revenues expect to be up 41% to £92 million. The adjusted EBITDA up 33% to 30 million. So, and that's for a full year, ended April. So very high margins there, in terms of good high margins in terms of EBITDA margin, very strong growth. Clearly HG are prepared to pay for that. And at that price, David, it's trading on an EV revenue multiple of 11 times, falling to 9 times on forecast, and a P of 49 times, falling to 41 times. So, and this is on estimated earnings growth of about 18% consensus on Bloomberg. My word, you would say that's clearly expensive, but clearly there's long-term value in this, given the strength of the customer base, the profit it makes from the business, the rate of growth. But it can show sometimes how the equity markets can get it wrong. And especially, as we go through tougher times, which we'll talk about in the markets, and valuations come off, and we'll be trying to spot companies which we think will stay the course and come out of the other end in good shape, and probably take a competitive share within it. But we'll talk about that. Right, quickly, another company that had results this week was Cerillion, telco billing systems. Again, one we've discussed before, ticker CER, market cap's 217 million. It had interims, and they had said that telecoms billing systems, they're seeing sales grow, driven by particular investment in 5G. So that was all quite positive. The revenue was up by 26% for the half, and that dropped through very strongly to profitability, with EBITDA up by 50%. But David, I noticed when reading this that they were saying that new orders were down year on year to 10.9 million from a high of 23.6 in the prior half, but the overall pipeline had increased. So it's a bit of a mixed message here. And they also said that the level of new orders from existing customers, that had increased, and that rose by 12%. So, I think that we'll be looking for more progress on order books for this one, because if you look at the forecasts, they're for revenue to rise from 26 million to 31 million. So, investors will be looking at the order books on this closely. Nonetheless, this is one that's made consistent progress and has been a very good performer.
Indeed.
That leads me quickly into Gresham Technologies, and it's GXT, 137 million market cap. Again, this is it. Their software automates banking controls, processes, reconciliations of accounts. They have risk and compliance systems, a good broad based financial software company, 270 customers across 30 countries, international spread. So that's all good stuff. And they announced a new customer win, and they had said that they got a win for their software with an existing tier 1 bank customer for £6 million. So a bit of positive progress there. This is a good one to look at. It's on EV revenue multiple of 3 times, falling to 2.8, and EV EBITDA of 14 times, falling to 12 times. So that's one that I think I will be taking a closer look at. And another one, which I thought was this is really interesting. There's an update on trading from SDI Group, David. I don't know if you've come across SDI before. Ticker's SDIS, 170 million market cap, and they make scientific instruments. Have you come across this one, David, before at all?
I haven't, so I'm interested to learn more.
Right, well, let me tell you more. I've always liked these types of companies as an analyst because they're what they call portfolio companies. It's whereby they have technologies, range of technologies and brands in tech that address specific end markets. And their range of particularly they have imaging tech, sensing technology and control technology, and they address a broad range of markets: life sciences, healthcare, astronomy, particularly with digital imaging, manufacturing, precision optics markets. So a nice broad range of end markets as we may get into more challenging economic conditions, and a broad range of products as well. And they came out with a statement saying that revenue and profit for the year is up to materially exceed current market expectations. Very good. So sales expect to be 49 million, and that's 20% organic growth. And they had 19% organic growth in the prior year, and adjusted profits before tax of at least 10.5 million, and it was 7.4 million in the year before. So that was very, that was nice and positive. And it's trading on a EV revenue multiple 3.4, falling to 3.1. So again, I'll have a look at that. And then I guess finally, David, for me, conscious of time, is Concurrent Technologies, ticker is CNC. There are no estimates out for this in the market at the moment. We'll get on to that, why that might be. It's 64 million market cap, and it has cash of 11 million and no debt. They have full year numbers out to December 21. Now, what do? They make, Concurrent Technologies make computer central processing unit boards. I mean, what are they? These are basically computer boards. I mean, your PC has a computer board in it with a processor in it, being Intel or AMD. They make those boards using Intel technology. However, these are very advanced Intel processors that go onto them, and the applications are likewise very demanding. So their computer boards are used in defense, telecommunications, aerospace, transport, scientific applications. So applications where it's heavy duty computing horsepower that's needed. And they said that they're looking at the annual revenues basically flat, 21 million, falling to 20.5 million for the full year. The EBITDA is steady at 5 million. Profit before tax was up from 2.8 to 3.5 million, and their dividend per share was like 2.6p, so that's flat. But what was interesting in all this is a couple of things were interesting. Number one, it has cash. Number 2, it has a new management team in. 3, it's a well-established brand in its market, and it has broad end markets. That's all of note. But they have said, bearing in mind they are using semiconductors on their products and PCBs, a lot of hardware, that they are taking a cautious approach to revenue and profit during 2022 due to uncertainty around speed of return to normal trading post-COVID, but also in light of difficulties in the global supply chain. And of course, they're all well documented when it comes to semiconductors. And so that could impact when they ship and produce and recognize revenue. So this one, the shares have come off. But as I say, I point to a new management team and cash on the balance sheet and the spread of customers. So one that's perhaps maybe having near-term difficulty, but may present a longer-term opportunity. We shall see. There we are. So that's the company updates, David. And I'm sure lots of interest to investors is the markets, because clearly they have been very turbulent over recent days.
Indeed. And first of all, thank you for your very interesting comments on those particular companies, and well worth having a look at all of them from the different aspects that you've been highlighting. I would just quickly throw in on SDI Group. They've also got a decent balance sheet. Looked like at interim's net cash or cash less bank debt increased to 1.1 million as at 31st of October from 0.8 in April of 21. So that's another little thing maybe to add to that story. And yes, the general markets, my goodness me, is it tricky. And what have we got? Well, we got all these worries relating to interest rates, recession fears, inflation, and all these forces are working against you. So what does one do? Well, I think personally, you look in the tech world, and you iron out and what you feel is good themes and those that have got longevity and sustainability. So areas like cybersecurity, clean tech, 5G, data center capex, and AI are, I think, those ones that fit in, to that good theme look. But if you start breaking it down and you look at software and semis, which, if you were running a tech portfolio, are going to comprise a fairly significant part of your portfolio. If you look at the chart technicals, the stocks, etc., they do not look favorable in the short term. Having said that, looking at individual companies, some of the companies that have been sort of generally holding up a little bit better have been names like Microsoft, Broadcom, Texas Instruments, and those that have not have been in the areas like for companies like Amazon, Shopify, and those names that are raising concerns on higher multiples, European exposure, consumer exposure, and those companies that have got logistical cost pressures, so suffering from the inflation there. So I sort of sit back and look at this in this tricky environment. I think to myself, well, what would I do? And I think particularly for our high net worth clientele, I'd be favouring dividend plays. And for that group of our clients, sort of closed-end funds, and I particularly like the dividend heroes. I mean, City of London has had 55 years of increasing dividends and yields just under 5%, so they're 4.8%. Now, I can sort of hear you saying in the background, well, hang on a minute, David, you're talking about the tech world, and this is all about a focus on growth. And of course, you're absolutely right. So that then defaults me, by talking of closed-end funds, at looking at Polar Technology Trust, and of course it has no yield. However, what I do really find quite interesting is that when you look at the benchmark performance, and what you find is that you're looking for 10, 5, 3 years or so, the NAV growth has outpaced the benchmark, whereas that hasn't necessarily been the case in the share price. And that comes down to the structure of closed-end funds, which you don't need to go into details about premiums and discounts. However, I do point out within that context that Polar now is trading at a 10-year record discount of 16%. Normally, it's around about 3%. So maybe that is, a fund that you should take a look at and see if you feel comfortable that it might present an interesting entry point for you. Now, going on to particularly individual names, you can get yields of 2% plus in the tech world from names like Broadcom, Texas Instruments, Taiwan Semi. Now, these yields are more elevated in the transitional energy world with names like renewables infrastructure, which has got a yield of, say, circa 5%, Greencoat UK Wind, which is 4.5, and hit an all-time high on the 3rd of May, and Gresham Energy, which is also in that kind of region of yields. So I guess with those technical charts that you look on a number of indices, ETFs, and companies, not giving you a clear picture of where these groups may settle down, I would then default to particularly these areas of the transitional energy names that I just mentioned a second or two ago, and those companies with dividends, with those companies that can generate sustainable dividends. So I don't know how you feel, Phil, but that's where I'd sort of suggest people look.
Yeah, no, it's a fascinating view, David. And we've talked. In fact, Andrew and I have talked about a number of those funds actually, and interesting to see what they do yield. And it is it's volatile times. So we're looking for companies that are robust, that have got stronger balance sheets, that can have got decent brands, good breadth of customer, and can come through a potential downturns the same way. I mean, I did that as an analyst when we're going, post Lehman's, when valuations got really, really hitting the markets. But it's also a good time to focus on divvies in particular, and the ability to pay out. So thank you for that, Dave. Some very good ideas there for investors.
My pleasure, sir. So I think thank you for your wise counsel, and I think we will wrap it up here and look forward to the next podcast with your good self in next week.
I look forward to it very much, David.